SolarEdge just dropped their Q4 earnings and the numbers looked pretty good. So why did the stock get hammered? That's the big question, the puzzle we're going to dig into right now. Let's get into it.
All right, so here's the central dilemma, the thing that just doesn't add up at first glance. SolarEdge beat on earnings, and they beat on revenue. On paper, that's a solid win. But then you look at the stock, a nasty sell-off, down over 5% on crazy high volume. What is going on here? That's the disconnect we need to figure out.
Okay, to really get why investors were hitting that sell button, we have to peel back the onion. We've got to look past those nice headline numbers and find the real story that's very deep in the financials. And bam, here's our first big clue. A GAAP loss, we're talking standard accounting here, of $2.21 per share. Now that is a jarring number, especially when you put it right next to that positive non-GAAP figure everyone was looking at. But, and this is absolutely crucial, management was really quick to clarify what this was all about. This wasn't because the business is failing. No, it was a one-time non-cash accounting charge, over $70 million, all related to foreign exchange quirks. You can basically think of it as a paper loss, you know? It doesn't reflect how the company is actually running day to day.
So, once you pull out that accounting weirdness, what do you see? Well, you see a company that's actually executing a pretty solid turnaround. They generated over $43 million in free cash flow, their gross margins expanded in a big way, and they even beefed up their net cash position. This all points to a company that was in what they call defense mode, and they were successfully shoring up their financial foundation.
But here's the thing. Management made it crystal clear on the earnings call. That whole defense phase, it's over. Now, for 2026, the game plan is changing. It's all about pivoting to offense.
And I mean, you really can't get much clearer than this quote right here. The CEO, Shuki Nir, literally said the goal is to shift decisively to offense. And what's their main weapon in this new attack? It's their next generation system, the SolarEdge Nexis platform.
So this new offensive strategy, it's built on three main pillars. First step, profitable growth. They want to go out and grab market share. Second, they're going to scale that new Nexus platform all over the world. And third, and this is where the long-term story gets really interesting, they're investing in what they call high-growth adjacencies. Basically, that's code for expanding into brand new, but related markets. Let's zero in on that third pillar, because the biggest new market they're gunning for is an absolute monster, providing the power solutions for the explosion we're seeing in AI data centers. Management thinks this could be a multi-billion-dollar opportunity just for them.
So what's the tech behind this? Well, they're developing something called a solid-state transformer, or SST. The simple version is this. It's a unique system that takes super high-voltage power and converts it directly to the 800-volt DC that all the next-gen AI chips are going to need. And here's the kicker. They're doing it with over 99% efficiency. For a data center that's just guzzling power, that kind of efficiency is a total game changer. Now hold on, it's super important we manage our expectations here. You can see it on the timeline. This is not a 2026 revenue story, not at all. This year is all about R&D and prototypes. They're targeting initial solutions for 2027 to line up with NVIDIA's new GPUs, but the real market ramp-up isn't expected until 2028. So yeah, this is a long-term play. All right, let's pull all these threads together. On one hand, we've got this really compelling long-term story with the Nexus platform and this huge AI opportunity. But we have to weigh that against the final piece of the puzzle, and honestly, the real reason the stock got hit, their pretty weak near-term guidance. And yup, here it is. This is the smoking gun for why the stock sold off, the Q1 revenue guide. That midpoint of $305 million, well, that's a pretty big step down from the $335 million they just put up in Q4. This is the headwind. This is what has the market so spooked right now. Okay, so for our segment, The Next Call, here's our take. For the Q1 results, we're actually predicting they'll come in at the high end of that guide, maybe $315 million or so, with gross margins staying pretty solid. For the stock itself, look, it's going to be choppy in the near term, but we do see potential for a re-rating. That's when investors start looking at the stock in a whole new, more positive light, once that Nexus platform really starts to scale later in the year. So that brings us to our official rating, Market Perform. All right, that brings us to our final segment, a little something we like to call the trade idea. Based on everything we just went through, here's our outrageous but plausible pitch, just like we were presenting it to an investment committee. The trade itself is pretty straightforward.
Buy long-dated call options on SolarEdge, ticker SEDG. And you want to be looking at expiration dates way out in the second half of 2026. This gives the whole story enough time to actually play out.
So here's the thinking. Here's the whole rationale. Right now, the market is laser focused on that weak Q1 guide. They are completely sleeping on the strategic shift to offense. The global rollout of the Nexus platform in the back half of the year, that is a huge potential catalyst to get revenue growing again. On top of that, any positive news about those AI data center partnerships, even just a hint of a deal, could send sentiment through the roof. So what's the bottom line? This is a bet that by the end of this year, the entire story around SolarEdge will have flipped, from rebuilding to growth is back on.
And of course, we have to say it loud and clear. This is not financial advice.